This is Macro Horizons, episode 328. Rising Mercury, Falling Yields, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of June 16th. And as we eagerly await the official first day of summer on Friday, June 20th, it isn't wasted on us that will be the longest day of the year, at least in terms of sunlight. Although, frankly, the BLS's decision to release payrolls on Thursday, July 3rd, makes that a close second. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the Treasury market put in a solid performance, in large part as a function of the core CPI numbers. On Wednesday, we saw the May CPI numbers come in below expectations, with core printing at 0.1 compared to the consensus of 0.3. Now, on an unrounded basis, that was 0.13, so a relatively high 0.1, but nonetheless, it confirmed the market's impression that the Fed is on track to reestablish price stability, with the one obvious caveat being that the trade war and the associated new tariff regime will introduce a meaningful uncertainty in the months to come. Now, within the details of the consumer price inflation data, we saw goods inflation actually came in negative. So while there were some signs of tariff pass-through to the end user, on net, we have yet to see tariffs spark another reflationary surge. Moreover, the 3-month annualized rate of core CPI declined to 1.7% compared to 2.1% in the prior month. This marks the lowest level in 10 months and, in a more typical world, would start the conversation about potential rate cuts in the near term. That being said, we do not anticipate that the Fed will be cutting rates over the summer, and we view the September meeting as the first truly live meeting for a rate cut in 2025. Even with that being said, monetary policymakers will remain data-dependent and patient as the contours and details of the bilateral trade agreements are ultimately revealed. Now, the market and the White House still has a few weeks before the expiration of the pause on reciprocal tariffs, and as a result, we expect that the market will remain wary of any incoming headlines related to deals, whether they're with the U.S.'s major trade partners, think Canada, China, parts of Europe, as well as Mexico, or some of the smaller partners, as the president has announced that within the coming weeks he will be sending out unilateral trade, quote-unquote, deals. If nothing else, the market views the next few weeks as pivotal in the trade war, if not necessarily the 11th hour. After all, the administration has demonstrated a willingness to extend the pause window as long as there is what Trump deems to be sufficient progress made on trade deals. The week just past also saw a few meaningful supply events. Most notably was the takedown of the 10-year auction. The $39 billion stopped through 0.6 of a basis point, and that truly served as an offset to concerns that there would be a wholesale buyer's strike in the Treasury market. Now, we're less concerned about the longer duration instruments. After all, overseas buyers tend to favor the 10-year sector and in. And so when we put this in the context of what it means for rates going forward, we're interpreting the 10-year results as a solid vote of confidence for Treasuries as an asset class.
Well, it was an important week in Treasuries, and that's not just because of the price action. We got May's CPI report that came in softer than expected, a 10-year auction that went nothing, if not well, despite all the concerns about deficits and a growth acceleration pressing treasuries toward materially higher yields. 5% in the 30-year sector was once again defended, and really, even after the inflation report was in hand, the market finds itself in a slightly richer zone, but a zone nonetheless, as the data is more or less conforming with expectations, and the Fed, the economy, and really, treasuries themselves, are still in something of a holding pattern with a bit of a bullish and slightly flattening tone that has brought the market off the recent extremes ahead of next week's short week that will be defined, of course, by the FOMC meeting.
And we're generally anticipating that the FOMC meeting is going to be something of a placeholder. The biggest debate is what the Fed chooses to do with the 2025 dot. Currently, it's at 3.9%, implying 2 rate cuts between now and the end of the year, and all else being equal, we would expect that that will be repeated on Wednesday. Now, clearly this is a wild card, and had core CPI in May not been as benign as it was, there would have been a stronger case for the Fed to signal 25 instead of 50 basis points worth of rate cuts. Even in this context, however, there's going to be a lot of economic data between now and the point in which the Fed is comfortable beginning the process of normalization yet again. So taking this all in totality, we anticipate that the next several months' worth of trading in the Treasury market will be a largely range-bound affair, with investors attempting to find the center point for the trading range. We anticipate that the focal point for the trading range will drift lower over the coming months and wouldn't be surprised to see 10-year yields attempt to trade below 4%. It's very typical for the Treasury market to rally during the summer months as the realities of the economic data set in and investors feel limited urgency to push a narrative in one direction or another. And as we think about the setup for this summer in particular, we've already seen the trajectory of inflation begin to cool, even though the reflationary risks presented by the trade war are very real over the next several months. Concerns are waning that the Treasury market is losing its safe haven status, although that debate promises to be relevant at least for a few more weeks until we're past the current deadline for trade deals and we see the June payrolls print on the 3rd of July.
And as we think about the different drivers of what we're expecting is going to be a drifting summer in the Treasury market with the bullish underpinnings associated with the uncertainty surrounding the global economy, it's worth acknowledging a degree of asymmetry between the Fed's dual mandates as the market continues to debate when and by how much the Fed will adjust policy rates next. Before Fed speak fell quiet ahead of the meeting, we heard from several committee members that the balance of risks around the dual mandate were shifting more toward risks of a reinflationary acceleration and away from concerns that the labor market was on the precipice of a sharp deterioration. Now that we have another month's worth of CPI data, that's probably helped moderate the most severe worries about a reinflationary acceleration, but within the payrolls report, there also wasn't a great deal to be worried about there either. An unchanged unemployment rate and slightly firmer wage gains hardly paint a picture of a jobs market that requires any immediate reaction from the FOMC. And so as we think about what's going to come next from Powell, softening inflation in and of itself is not necessarily the only thing that needs to happen for us to see a rate cut. For that, we would need to see more evidence that the labor market is rolling over and the job side of the dual mandate become a greater concern. Conversely, everything we've seen on the inflation front over the last several months has been cooling, maybe not as fast as the Fed would like to see, but on track enough that there's not really a realistic conversation, as there was not so long ago, about the potential necessity for an about-face in the path of rates and the potential for the next move to be a hike. So really what this all translates to is an easing bias, but really an emphasis on data dependence and a desire to keep monetary policy where it is, given that the Fed sees rates as modestly restrictive, but at least so far not restrictive enough to trigger a sharp inflection higher in the unemployment rate. Add to this growth concerns about the trade war, and that will keep buying interest waiting to take advantage of higher yields in treasuries, but it seems for the time being, the Fed wants to take the summer off.
We certainly can't blame monetary policymakers in that regard, although it will be interesting to see how the process of selecting the new Fed chair unfolds. And as Trump has hinted at least, that process is currently underway, and presumably in the next few weeks, if not couple months, the market will have a much better sense as to who the president is focused on to replace Powell. Now, there has been conversations about that potentially being Bessent, although the White House has subsequently denied these rumors, which one could argue only reinforce their relevance. Admittedly, it would be an interesting transition from being Treasury Secretary to being the head of the Fed, although recall that Yellen transitioned from being the head of the Fed to being Treasury Secretary. The perceived risk from the market's perspective is that Bessent would have an atypically high degree of loyalty to the president who nominated him. Recall, however, that Powell was also nominated by Trump. So we're of the mind that the market is currently overly concerned that Bessent would be disproportionately loyal to Trump versus any other Fed chair. It also goes without saying that anyone who replaces Powell will, almost by definition, be more dovish. And so that leaves us sympathetic to the notion that in the event that Powell chooses to delay rate cuts further and further into 2025, that these rate cuts will simply be made up in 2026. Now, this isn't to suggest that the incoming Fed chair is going to start with 100 basis points worth of rate cuts, but presumably there'll be a stronger easing bias by the middle of next year.
This also touches on the idea that Bessent had floated even before he was announced as the nominee for Treasury Secretary, and that is this concept of a shadow Fed chair that is announced well in advance of Powell's term actually ending, and then theoretically that person's opinions on monetary policy could be traded by the market on the understanding that the changing of the guard at the Fed will usher in, to your point, Ian, a materially more dovish monetary policy backdrop. Now, it's probably too soon to say that that's what's ultimately going to play out, but it is something to consider given how early the relatively serious conversations around Powell's replacement have picked up. And coming into this week ahead of CPI, there was unquestionably still, even after the price action last week, a bearish sentiment toward treasuries and especially in the longer end of the curve. There was a lot of discussion around this week's 10 and 30-year auctions being a referendum on the investability of treasuries and the potential for this week's auctions to go poorly, given that, to read the financial press, no one seems very excited about owning longer-dated treasuries in the current environment, given the fiscal and macroeconomic backdrop. To use the 10-year auction as an example, it seemed that those fears were a bit overblown, given the fact that despite coming at the low-yield marks of the day, the auction stopped solidly through, and frankly, the underlying bidding statistics showed nothing if not solid end-user demand for the 10-year point, even after we saw yields retrace fairly meaningfully off their latest highs. This was certainly a welcome development for Secretary Bessent and President Trump, who still would like to see longer-dated yields lower, and especially as summer grinds on and we approach the August refunding announcement, we continue to see relatively limited scope for an increase in long-end coupon supply, and instead anticipate that this Treasury Department is going to continue leaning more heavily on the bill market as a source of financing for the deficit. Now the picture is going to be muddy as the TGA continues to be run down and we make our way through this current debt ceiling episode, but if July's 10-year auction is any indication, Treasury auctions are still bringing out buyers.
And that's a dynamic that we expect will continue over the course of the summer, especially as there remains a heightened level of uncertainty pertaining to the trade war. Now, eventually, the Treasury market will move on from trading each trade war headline, and presumably that will occur when the administration has reached a critical mass of bilateral agreements with the U.S.'s major trading partners. In terms of a timeline for this, we're expecting that will occur sometime in July, leaving August and September as a key time frame to return to trading the fundamentals. And that will correspond with the point at which one would expect the fallout from the trade war to finally materialize in the economic data. This will leave investors on guard for higher unemployment, higher goods inflation, and a consumer that begins to struggle with another leg higher in prices.
Geez, Ian. Sounds like someone's excited for summer.
It's always sunny in treasuries.
After all, we are bond people.
In the week ahead, we see that Thursday is a market holiday and Friday has remarkably little economic data, all of which suggests that the bulk of trading will be condensed into the Monday through Wednesday window. On the supply side, we see $13 billion on Monday morning of 20-year notes. Recall that the results of the last 20-year auction triggered a very meaningful sell-off in the Treasury market, so this will be a takedown that surely garners a fair amount of attention. We also see $23 billion in 5-year tips on Tuesday afternoon. On the data front, We have retail sales for the month of May, which is expected to show a modest decline of 0.6%. We also have import prices for May, which when combined with CPI and PPI will help investors put the finishing touches on core PCE estimates. At the end of the day, we're anticipating a low 0.2 or a high 0.1 for core PCE. The main event, however, will be Wednesday afternoon's FOMC rate decision. We're not expecting a rate cut or any clear guidance from monetary policymakers as to when the next rate cut will occur. Powell's incentives at this stage will be for a relatively balanced tone that emphasizes flexibility in the coming months as the market waits for greater details on the bilateral trade agreements from the administration. Moreover, it's clearly going to take several months for the economic data to catch up with the realities of the new trade regime. All of this suggests that this particular FOMC meeting will be a placeholder. The one wild card comes in the form of how the Fed chooses to update its SEP and the beloved dot plot. We're in the 50 basis point camp. By that, we mean simply expecting that we'll see the Fed retain the 2025 dot at 3.9%. There is, however, the risk that the FOMC chooses to be a bit more hawkish and instead of 50, signals 25 basis points worth of rate cuts between now and the end of the year. Given the political climate and the recent trend in inflation, and to a lesser extent employment, we suspect that the path of least resistance will be to retain 50 basis points, although we are open to the risk that 25 basis points is the ultimate outcome. In terms of the economic projections themselves, the March SEP showed what we'll characterize as a fairly ideal outcome for real GDP, effectively coming in at the long-run average of 1.8 at each of the next 3 years. We find this outcome to be difficult to envision. We'll either see higher or lower realized growth at the end of the day. Nonetheless, we don't see any incentive for the Fed to change that on Wednesday. The core PCE figures, most recently revised up to 2.8%, could be edged higher yet again, and we suspect that that will be another key takeaway from the event. As far as the unemployment rate, seems very little reason to adjust that higher given the recent 4.2% in May. Therefore, on net, we're approaching the week from the perspective of anticipating another round of curve steepening pressure led largely by the front end of the curve, with a nod to the fact that the week's activity will be definitively front-loaded. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And while one might argue that Thursday's market holiday should be observed on Friday, we're of the mind that it is just SIFMA's way of telling us all to enjoy a 4-day weekend. And we are certainly open to that message. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.